My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour is a guy who is thankfully flexible with his calendar, given that I had to reschedule this conversation, Daniel McNamara. Dan, introduce yourself to the audience. Who are you? What's your background? How'd you get involved in interested markets? And are you really that worried about commercial real estate?
Thanks for having me, Michael. Yeah, so my name's Dan McNamara. I founded Popo Capital in 2021. Popo Capital is a CMBS credit hedge fund. We founded it in 2021 with the belief post-COVID, kind of the commercial real estate market was changing, fundamentally changing in different sectors. And we thought that given the ultra low interest rates and the changes within retail and office, we felt like the next shoe to drop at some point was going to be in commercial real estate, and commercial real estate in general would be at the heart of distress. So that's, my brief background. I've been doing this for about 20 years, always in CMBS and with a focus on credit. We're a long short manager. So, just as much as we're trying to uncover interesting CMBS credit bonds on the long side, we obviously are spending a lot of time today focusing on shorts within the commercial real estate and CMBS sectors, where we can express some of our, what I would deem bearish views, specifically in the office sector. So to answer your question, in short, I'm very concerned about certain parts of the commercial real estate market. Definitely anything kind of class A or below in office. We've had this secular change in the way we work. And, I'm a big believer. I don't, as of the last couple of years, I never really believed that we were going to go back, or the majority of us were going to go back 5 days a week. I believe the hybrid, given the technology surrounding us and the flexibility the technology gives us, hybrid was here to stay. And, unfortunately, that's going to cause some serious pain in the office sector, especially in the lower quality office like B and C office. So yeah, that's my brief background there.
So you use the term correctly. So at some point that it's going to matter in a big way. Obviously, the headlines are more and more focused on commercial real estate. What is there a catalyst for there to be some real distress, or is it one of those things where just suddenly, for whatever reason, the investors in the market broadly starts to care about this?
Well, that's a good question, because if you look at the delinquency rate in CMBS right now, we're still below 4%, which is really nothing. 4% delinquency rate is nothing to really worry about, and we're not even there yet. The biggest issue and the biggest worry I have is this kind of this wall of maturity that we're starting to get here. Between now and the end of 2025, you've got about 1.4 trillion of CRE debt that needs to be refied. And that's a problem. It would be a lot of debt anyways in a normal market environment. In general, there's about 4.5 trillion of CRE debt, and it's about $11 trillion market. So it's a very large market. And we're now coming into this wall of maturity that without, CMBS right now, year to date, is down about 90% to last year's new issuance. And last year's new issuance, we did about 75 billion, and that was not a great year. So you're talking about the CMBS market, which is effectively shut. We are getting a couple deals done here and there, but nothing like we used to. You then have, the largest lenders in CRE space are regional banks, and everyone knows what's going on there. So it's a really daunting task to think that we're going to be able to digest these maturities. And really that's what we're trying to uncover here, is that, we think that there's going to be a large amount of losses for the people that are holding this debt, whether that's in loan or bond form. And we also think, though, that, what the commercial real estate market does well, especially in, when there's cyclical issues like some of the sectors are having, we think there'll be a lot of extensions. The banks don't want to realize losses if they can kick the can and extend and pretend. And, CMBS bondholders will do the same thing. Special servicers will give extensions when necessary. So I think this is going to take a long time to play out.
Right. So basically, if I'm hearing you correctly, it's more of a process that's going to be lumpy, frustrating, and opportunistic for managers like you, rather than something everybody sees all at once.
Agreed. Because we just, while there is, plenty of dry powder at times on the sidelines, you always hear about dry powder. People are dying to get their hands on distressed debt. And I think Barry Sternlicht said something yesterday, was quoted as saying something similar. And that's true. There's no doubt about it. I mean, we're one of those players who, we're excited about the opportunities to, debt has become expensive for sponsors. And from that perspective, you can actually get a decent return if you're careful about your credit work. But this is not going to happen all at once. I mean, this is going to be a multi-year process. There's going to be pain from sponsors. There's going to be pain from some of the current debt holders, but there's also going to be a lot of opportunities. Broadly speaking, I'm not, I don't paint commercial real estate with this broad brush, right? You have all these different sectors. You've got, office clearly is the one in kind of the crosshairs of everybody, and that's going to be probably where the most of the pain is felt. But if you step away, you kind of have, in retail, for example, it's a tale of the haves and have-nots. Your Class A retail is doing pretty well. Some of your lower quality enclosed regional malls are either dead or dying. But what that does is provide opportunity, because you've got assets in the same sector that are thriving, and then you have some other assets that are kind of dying. From another sector that's very similar is hospitality. People don't talk about hospitality as much, but it's a large sector in our space. And you have business travel that's slowed dramatically, and I'm not a big believer that I think business travel is getting back to 2019 numbers anytime soon, or maybe anytime in my career, because of the way we work now. But that being said, the leisure hotels, they're doing great. They're through 2019 numbers, and honestly, I couldn't be more bullish on anything in our space. Some of these higher end hotels that are catering to people who are dying to travel again. So it's a very diverse market and complicated market, and there's going to be a tremendous opportunity on the long side. And today, I still think there's a tremendous opportunity on the short side also.
And presumably because that's the kind of path that you see or sequence, it becomes hard for the Fed to really step in and do much, because if you have sort of a disjointed default or disjointed stress, right, it's hard for the Fed to lower rates and then try to bring them back up and then lower them again for the refinancing. I'd argue it's actually easier for the Fed to deal with a crisis when it's all at once, as opposed to when it's a kind of a rolling crisis.
I completely agree with you there. If we just kind of compare this to 2008, and this is clearly a different situation. 2008 was more about the residential market, not that there wasn't pain felt across asset classes in general. But that was probably a clearer, obvious way for the Fed to deal with this, right? And to lower interest rates. The problem was more cyclical than anything. A lot of extensions were given in our market, and basically time did heal a lot of wounds. In this case, you've got certain properties that are thriving and don't need lower interest rates. And in fact, lower interest rates could, hurt the broader economy. I think everybody that's in commercial real estate or an owner of commercial real estate today, they're all calling for lower interest rates. And honestly, I'm not a big believer in that in general. I don't necessarily think that a 3.5% 10-year note is that high. So, and if we can't deal with a 3.5% 10-year note, then we've got real big problems. So for me, I don't think the Fed is going to be the savior of the commercial real estate market. I think this is just a cycle that needs to play out. Losses need to be taken, and again, there will be plenty of opportunity if you're thoughtful about credit, but you really got to be careful here, because it's become a credit pickers market. And unlike the majority of the time between 2009 and let's say 20, where you could just basically buy anything and it would go up, now you have to be really thoughtful about risk and risk management.
Let's talk about how geographics play into this. I mean, presumably certain sectors of commercial real estate, office, retail, hospitality, all that will obviously differ by state. I had Grover Norquist on yesterday, and he was bringing up this whole point about how a lot of these states are lowering taxes, which is causing, even going to zero, which is causing a lot of migration by workers who not only now can work remotely, but also get the benefits of lower state income tax. Are there certain parts of the country that you're focused more on the short side as opposed to the long side?
So yeah, without a doubt. I mean, CMBS broadly is geographically diverse. So it's not as easy as just saying, well, I want to be short San Francisco office space. But that being said, we are, as we go through these deals with, 50 loans in an average CMBS deal, call it, you do spend a lot of time trying to get your hands around, the obvious problem childs in our market, which, San Francisco office, just cannot get out of its own way. And there's so many issues in San Francisco, right? It was overbuilt because of the tech boom, and now a lot of the tech companies aren't making people come back in 5 days a week. But then you've got the political issues there, and in general, you're seeing a lot of people leave that area, and whether they're headed down to South Florida or Austin, which is two places clearly from a tax perspective is advantageous for people to move to. You are seeing these have and have nots just geographically too, right? And, one of the few places I would love to own office right now is in Southern Florida. I mean, that's the only place where we talk to people where you're like, oh yeah, I am building an office building. Now, the only problem is you still got to get debt on it, but overall, for the right property in the right location, people are looking for opportunities to finance these things. So geographics are playing a huge role in what's going on behind the scenes in commercial real estate.
If you were going to guess at how the drawdown plays out across the board in commercial real estate, I mean, how severe of a decline would you expect on average?
So that's a tough market. Tough to say in general. Given all the sectors, broadly speaking, I think you could see across the board a 20 to 30% repricing in different commercial real estate sectors. But you got to realize that within those numbers, broadly speaking, you could have, there's headlines out in the last week or two where 2 San Francisco offices are up on the market and they're expected to trade down 80% from 2019 numbers. So, you've got stuff that's down 80%. And honestly, you've got multifamily in certain, let's just say the Sun Belt that's thriving and NOIs are up dramatically. And actually that property has appreciated in the last 4 or 5 years. So it's really hard to kind of paint it all with the same brush. But again, I think that's what makes the opportunity so interesting is that you can be thoughtful about risk and where geographically you want to play, where in the capital stack do you want to play, regardless of just saying, hey, I just don't think it's very smart today to be like, I'm really bullish on commercial real estate because I want to be a contrarian. That's to me is a dangerous move because if you're not careful, you're going to buy the wrong stuff, or maybe you'll buy it too early. That being said, I don't think this is the big short. I don't. Broadly speaking, I think that you have to be very balanced in the way you invest in this market today, whether that be in securities or loans or equities on the commercial real estate side. I don't know if shorting Boston Properties or SL Green, given their 75-80% drop in their stock price, is necessarily a good move. I don't think those companies are going anywhere. And again, we don't invest in equities, but I just think that you may have seen from a publicity perspective a peak bearishness in office space. I mean, I pick up Twitter or I pick up the Wall Street Journal or whatever it is, and you just read my Twitter feed. It's a lot of negative news. It really is. That being said, we're going to get through this. There are still needs for some office space to be, some people to be in the office 5 days a week. You've seen J.P. Morgan and Goldman Sachs come out and say that they want their employees back 5 days a week, and that makes a ton of sense to me. Very large companies where young people are learning and through osmosis of the senior people. If you're Jamie Dimon, you need those people back in the office 5 days a week, even if you risk kind of alienating some of your older, more senior employees.
It's actually, you kind of hit on a direction I wanted to go, which is just in general thinking about the efficiency of the space. I mean, to your point, if everyone is overly bearish on office, then presumably the price is already reflecting that to some extent or to a large extent.
Yeah, no, you're absolutely right. Right, and you can look at the stock prices of some of these REITs and equity space. And, they've gotten decimated. So it's difficult even in the CMBX space. We've moved down at the bottom of the capital stack, 20-25% over the last year. We've moved lower. Now that doesn't sound like a big move, but you do have these investment grade indices that were trading in the 90s not too long ago, and now they're trading in call it the low 70s depending on the index. So you've got a repricing. You definitely have plenty of fear out there. But I don't think there's too many obvious outright shorts in the market that I just believe that you have to be more thoughtful and pair it with other things because everybody knows office is struggling. Everybody. The question is, how do you play it? And I think there are ways to play it in different instruments, but you just got to be very careful. This is not 2008 and The Big Short. This is more of a nuanced market right now, and you got to be very careful.
Yeah, and actually, the point about this being a nuanced market is not just isolated to CMBS. I mean, you've got so many different markets moving in ways that seems unusual. You've got, even just in public equities, large caps holding up nicely, small caps on a relative basis looking, for lack of a better way of saying it, like death because of the co-movement with regional banks, right? So no, you don't have that kind of co-movement that you saw during the great financial crisis. There's a lot more dispersion, I'd argue, internally in different asset classes.
Yes, no, no, totally. You're seeing the dispersion, and sometimes when you look at the broader markets, you almost don't think that much is going on. Today's obviously an exception. The markets are doing incredibly well, but sometimes, given the banks are getting hammered on a day, but the tech stocks are saving the banks or saving the indices broadly, you really need to understand what's going on beneath the surface. And what's going on, commercial real estate specifically, and whether that be on the lending side or what's going on with the warehouse lines that all these large banks have out to some of the shadow banks that I would say that make a lot of loans. You really got to look below the surface because there's so many cross currents, and it's very difficult to kind of get your finger on what exactly is going to happen over the next 6 to 12 months, whether that be broadly in macro or just specific to CMBS or commercial real estate.
Speaking of below the surface and kind of getting more detailed, I'm curious to hear your thoughts on just in general the reaction to regional banks, especially the last couple of days here. I mean, I've noted on Twitter that when you look at the regional bank equities, even when you include today, I mean, they're basically crashing like it's another lockdown. Do you get a sense that the marketplace in general is just treating this all with one broad brush? I'm going to assume that the debt side of the regional banks looks maybe different than the equity side.
Yeah, I mean, there's no doubt about it. There's a witch hunt right now going on in the regional banking space, and I think right now that the first thing everyone wants to talk about is the mismatch between assets and liabilities, and really the biggest issue for some of these banks was just their duration. You had they owned a bunch of 2% mortgage bonds that have negative convexity, and when rates rise, all of a sudden your duration extends massively. And then you have these deposits that once there's smoke, everyone runs. So the first part of this wave in my opinion, on the regional banking side was all about interest rates. And I'm surprised it took that long for interest rates to become a worry. I mean, in the lending markets and the CMBS markets last year, the focus was on interest rates, right? We had interest rates going up 300 plus basis points, and what is that going to do to valuations and cap rates and everything else? Well, clearly cap rates go higher, valuations go lower, but that to me was something more cyclical. The issue now, I think, that's coming, more into light and more maybe with what a signature bank had issues with is commercial real estate. You've had some of these regional banks that probably became a little too comfortable with taking the deposits and lending in the commercial real estate market. And now I think that is going to be more of the focus where, okay, we had an interest rate issue, but now we have a credit issue. And, how many credit issues do we have within the regional banking system? And honestly, that's a really difficult question to answer. Generally a percentage basis how much is CRE, but just broadly painting commercial real estate loans with the same brush, it's difficult. Again, you've also had certain banks that are very focused on construction lending versus other banks that are mostly focused on multifamily down south, which is doing fine. So I now think that it's going to be more about digging in and figuring out who was over leveraging themselves to the commercial real estate market or certain sectors of the commercial real estate market versus who's being thoughtful about risk. And even though the commercial real estate, they may have large exposure to the commercial real estate market, that doesn't mean they're going out of business. That doesn't mean they made bad loans. It just means that, it's going to be a bumpy ride for a little bit until we digest all these things.
Yeah, presumably there's going to be consolidation. I had somebody tweet at me saying in 3-4 years, it's going to be clear that the outcome of all this is that there's going to be just a 3-bank system and the Federal Reserve as far as the U.S. And while that sounds extreme, I mean, I guess that's sort of the whole point, right? the too big to fail dynamic is still alive and well. It's just that these regional banks are not too big to fail.
Yeah, no, that's kind of scary, right? Because the regional banking system exists for good reasons. They are your local lender, whether that be for a business loan or personal loan or commercial real estate loan, whatever it is. They traditionally are the ones that are lending to small businesses, and obviously, small businesses are so important to our economy. So we need a regional banking system, and they need to do something about this because we can't just have Bank of America, Wells Fargo, and J.P. Morgan. That's not going to be good for the economy. That's not going to be good for anybody. So we need to do something to instill confidence in some of these regional banks. I still think that the shedding of certain banks, it's cyclical and it's probably healthy. There's some of these banks that mismanage risk and whatnot. I'm not saying every bank that's gone under deserved it, but sometimes that's what you need in a recession or repricing in the market is kind of just a cleanse of some of these poorly run banks or mismanaged banks at times. So we'll see. I think there'll probably be more failures without a doubt, but we just got to make sure there's no more bank runs. We got to make sure that the depositors are protected and there's confidence in the system. But stock price, I'm sure there'll be more banks that stock prices are going to zero, bonds are getting wiped. And again, I don't think that's a major issue as long as we keep confidence in the overall system.
On that point about that sort of refinancing wall that you see coming between now and 2025, I've long made this argument that I think we're this a credit event out there. And for me, it was more than just commercial real estate, just a function of a lot of corporate loans coming out of COVID had a maturity of 3-4 years. So you end up having a lot of, potentially zombie companies having to roll over and refinance into higher rates. And who knows if they're going to actually be able to do that and survive. Presumably the bond market's going to see this and start to, credit spreads will start to widen way in advance to sort of send a message to the Fed, right? You haven't really quite seen that yet, but from your experience, what's sort of a typical response time by the market to when a refinancing stress might occur, right? Because it's never when the actual refinancing occurs. It's with a delay, or rather with a lead time.
Yeah, no, there's always a bit of a lag in a lead time. I personally, it's interesting when you look at the corporate market because you really aren't seeing too many signs of distress there in high yield spreads or IG spreads. In the CMBS market overall, we've had a repricing, and some of that's just due to fear of being fired. People don't necessarily want to say, "Hey, you know what? I really like you. I want to invest in commercial real estate bonds." But what you've seen in the CMBS market is the credit curve steepen dramatically. And basically, that just means, from AAA all the way down to call it double B, single B, the bottom of our capital stack. You've seen people say we don't want any more real credit risk. AAA CMBS is pretty loss remote. I hope we never see a scenario where 30% credit enhanced bonds are taking losses. I don't think we will. We didn't see it in 2008, and I don't think we'll see it now. But the corporate market is just shrugging this off, which is very interesting because, like you said, there's going to be a ton of supply in that side of things, and some of that's going to be what I would say dodgy supply, right? You've had companies that looked great coming out of COVID because of zero interest rates and their business model was hot and everyone was throwing money at it, but today, as they come kind of in this new environment with interest rates 300 basis points higher, I think you are going to see some zombie companies and you're going to see some more bankruptcies and the distressed corporate debt market kind of come back to life. We haven't had one of those in a long time. And again, I think that's a healthy cycle. And we just need to figure out, what companies can kind of survive over the next 5 to 10 years in this new interest rate regime. Because I really just don't believe that the Fed's taking rates back to zero. And if the Fed does start cutting rates, I think we have much bigger problems.
Just to reset the room for everybody here, please make sure you follow Dan McNamara here on Twitter. Again, if any of you want to come up and ask questions, click that bottom left mic request button. As always, this will be in podcast under Read Lag Live. Let's expand a little bit on the retail side for a bit here, Dan. Every time I look at the retailer stocks, it's always amazing to me. They peaked relative to the S&P 500 back in 2021, which I'd argue is early 2021 when the bear market really started, and the trend keeps on lowering. In other words, the retail stocks keep on underperforming, so there seems to be bet that consumers are going to keep on weakening against the backdrop of strong employment numbers, which we can debate. But within the retail space, what are some of the areas that you think could really actually thrive in what you see coming?
Well, you've got your Class A operators, right? You've got your Simons who have taken advantage of everything that's been thrown at them. They are, a class overall. They're a Class A operator, and most of their properties are thriving right now. But what they did in the last, I would just say post COVID in general, the last few years is they shed all of their lower quality assets that they didn't believe in over the next 5 to 10 years. And they weren't the only ones, but I use them as an example because you basically had what was viewed as a mall company pre 2020. And then you had David Simon coming out, post COVID saying, we are not a mall company. So I just think that's interesting. And I think that's really smart where, you're pivoting, you see the writing on the wall, you see what's going to work in this new environment as e-commerce continues to take up, a bite out of the brick and mortar. You're seeing firms that didn't really adjust to this new world. Bed Bath and Beyond is obviously one on everyone's mind. One of their former companies, I just saw a headline today that Christmas Tree Shops is going to be bankrupt also. So, Bed Bath and Beyond, it wasn't too long ago. We were post COVID, we were watching their stock go bonkers. Became a meme stock, and that was a little silly, obviously at times, because now you've got a company that is bankrupt. So, retail is going to be really interesting. People still want to go out and touch and feel stuff and try stuff on, but they don't want to necessarily do it in a dark and closed, dirty mall. So I think that retail, to me, on the higher end, I was always pretty positive on it. I think it's probably even outperformed even my thoughts. But that being said, there's still a lot of pain to be felt and probably a lot of bankruptcies in retail coming. So I think the retail liquidators out there are going to be very busy over the next couple of years.
Let's talk about sort of just local effects when you have vacancies and bankruptcies among retailers and office space. I mean, presumably there is a link between that and crime and people wanting to leave. I'm going to assume that as this plays out, there's going to be some interesting kind of migration dynamics as a result that come out of this.
Yeah, without a doubt. You're seeing let's just use New York City as an example, and you can use office if you want. And, New York City's budget relies significantly on commercial real estate taxes, right? So you're going to see budget cuts, which is going to lead to, probably more crime. And it's going to lead to New York City, what it feels like at times, feeling a little dodgier and distressed, and, people migrating away from the city, whether that to be go to the burbs or whether that actually means, we're going down to Miami or Palm Beach or whatever it is where a lot of the finance jobs are headed. But it does feel a little scary from a death spiral in certain cities. I mean, San Francisco, I hate picking on them over and over again, but it's the easiest one to pick on. You just, the migration wave out of San Francisco and into the burbs or into different states, whether that be Texas or Florida, it's real. And it's, it's happening every day. And I think that, San Francisco is going to have a very, very hard, difficult time bouncing back. But that being said, if we just use New York as an example, I don't think this is going to be 1970s, New York. New York City is burning. But I do think that politically we got to get our arms around the fact that commercial real estate prices don't just go up every year, and you're going to be dealing with a budget surplus from all these real estate taxes. You're going to need to right size everything and be very careful about our spending, because if you don't, you're gonna have major issues down the road. I mean, we all know it, we all see it. Eventually, you're going to pay the piper. So, that's a scary thought of these budgets in different municipalities that are very strained.
Let's talk about the hedge fund for a bit and how you manage position sizing and trade and do research. First of all, I want to make the assumption that once you have a thesis on a particular credit issue, you're not necessarily trading it very actively because it takes some time for these things to play out. But how do you go about managing risk and managing position size in the context of the different sectors that you're analyzing?
Yeah, no, that's a great question. And, you're right. When you're dealing in the CMBS credit space, and just take a step back, like AAA CMBS is about 80% of the market. So when you're dealing in a very small niche part of the market, when you're dealing in just in CMBS credit, and it's primarily money managers and hedge funds that play in that space. Up the stack in AAAs, it's insurance companies, it's banks. Some money managers still play in AAAs. A lot of it do actually, pension funds, etc. But the credit space is small and it takes an extremely large amount of work because the way we look at the world when we're investing long or short in CMBS credit is we're looking at all the underlying loans in a deal and re-underwriting them and coming up with our own terminal value. What are these 50 properties in this one CMBS deal worth? And whether we're going long or short, we're doing the same process, right? We're underwriting and coming up with our own valuations. At times, obviously, if a deal was done 5 years ago, there could be NOI growth in certain sectors, and then obviously NOI could deteriorate or vice versa. So for us, the heavy lifting is the underwriting, and that's really where we spend all of our time. And then you'll get to how do you source the assets you want. I mean, this is a market that you have to remember. This is not a market that trades electronically. It still trades like it's 1986. Everything's either over a Bloomberg or over the phone, and nothing is cleared. Even when our derivatives aren't centrally cleared, they're all over the counter. So it's a very slow moving market, which requires a lot of heavy lifting, and it's all done by institutional accounts. There's really not a retail aspect to our market. In fact, people always ask me how can I short CMBS? I see that there's actually an ETF that says CMBS. The ticker is CMBS. What people don't realize is if you're shorting that, the majority of the assets in that thing are AAA and government guaranteed CMBS agency bonds. So you're not really shorting that San Francisco office like you think you are if you're buying puts on the CMBS ETF. So it's definitely an institutional market. It's definitely takes a lot of work. You kind of have to come at it as a bond trader, but also almost more as a commercial real estate investor, and be thoughtful about whether you're what you're buying and where you're buying the capital stack. From a sizing positions, it's not easy to size positions in our market because it's such a small market.
Yeah, the liquidity's got to be very low, right?
Yeah, it's very low. I mean, the indices on the CMBX side, which is, again, we're talking about our indices, our most liquid hedge. You're basically dealing down in credit, 5 million up, on the bid or the offer. So there's not a ton of liquidity there, which means actually, a lot of the bigger players, the large names, they don't necessarily play down in the CMBS credit market because they can't size it and they can't scale it. It's good for us. It's good for nichier, smaller, nimble managers because a few million of a bond or 5 million of an index short, that's very meaningful. But we don't have a hard limit on our position sizing. Just broadly speaking at Popo Capital, but we do think a lot about how we're managing our risk and what size is too big in an individual position or an individual sector. But I wouldn't say there's any hard and fast rules from that perspective. You really can't in our market versus whether you're dealing in public equities or something more liquid.
Which I'm going to assume makes it challenging to find the right kind of investors, right? Because you can correct me if I'm wrong, but I'm going to assume that you've got some kind of gate or something that certain intervals under which investors can request their funds back. I mean, you don't want to have a liquid hedge fund somebody can redeem from when you've got illiquid securities underneath it.
Exactly. And one of the things in our hedge fund, we only invest in bonds, and we won't put loans in the fund, and that's from a liquidity perspective, because your traditional hedge fund liquidity is quarterly with usually like a 60-day heads up. So you got to be very careful about what's going into the fund, and how you're managing that liquidity risk, because these, while they are bonds, they're credit bonds and they're what I would deem less liquid. So that point of it, managing liquidity but also, getting exposure to kind of the juiciest pieces of the CMBS credit market, whether it be long or short, you got to be very careful. For us, I think the biggest thing too is knowing that we're playing in a less liquid market is managing your leverage. I think that's the most important part. And people sometimes don't realize the embedded leverage in these tranches, right? These CMBS tranches where you're cutting up from AAA all the way down to unrated pieces of bonds, you have a significant amount of embedded leverage in there. So, for us, we'll never use more than a turn of leverage, and we just don't believe that you need it. We saw in 2008 and even in 2020, even though it was quick, we saw a lot of firms, struggle with leverage, and you saw a lot of margin calls and a lot of people get stopped out in March of 2020 or April of 2020 at the lows, which was devastating because you basically, we always talk about impairment from a credit perspective, but you basically had impairment to these funds because they got stopped out of positions at the lows. So if you look at the performance of whether they're money managers or hedge funds in our space in 2020, you had managers that were up 20% in certain pockets of money, and you had managers that are down 50, and that was almost all leverage. Things bounced back so quickly, and in reality, we didn't have that many credit issues because of the Fed's actions. So we think a lot about liquidity, but I think more importantly, the leverage we're putting into our book.
Yeah, and presumably also that then there's I'm going to assume a lot of back and forth around the net position, right? So a lot of people talk about long and short, but the net long or net short is what really drives the ultimate performance. So how do you go about that sort of differential?
Yeah, so our nets our gross position, like I said, would never be more than 200% because we keep our leverage very low. But our net positioning is something that could change all the time. I mean, for the most part, last year, our belief was the credit curve was going to continue to steepen. So we were running a small net negative. So we were effectively, our portfolio was slightly net short. Again, I say slightly because it's very difficult to time these things. You don't necessarily know when there's going to be a dramatic repricing in CMBX or any instrument you're using to hedge. So you got to be very careful about that. And, even though we really had the highest conviction in some of our shorts, we were still, what we were doing on the long side is we were buying, and we still are buying, interest-only securities, because I believe, like we touched on earlier, this is going to play out two different ways. You're going to have major losses on, certain assets. Let's just say a C office that was a 50 LTV theoretically 6-7 years ago is now 150 LTV. That's where the losses are going to come from. But what we need to get our arms around is the majority of the loans aren't necessarily 150 LTV today. You have interest rates that are pressuring some fundamentally sound markets, whether it be multifamily and industrial. And yes, interest rates are higher, so cap rates are slightly higher, so valuations are up. And what we like to look at is some of those other sectors or some of those other loans in these CMBS deals where LTVs are higher. Yes, refinancing is going to be difficult because your loan went from a 60 LTV to an 80 LTV. But what's going to happen there is extensions. You're going to have, whether it be if it's in bond form, the special servicer, or if it's a loan sitting on a bank, you're going to see a massive wave of extensions. Less so in the lower quality office space or lower quality hospitality space, but more so in everything else where, sectors where we're just digesting higher cap rates, sectors where valuations are down a little bit, but, it's not a major credit issue. So that's what we're doing on our long side of the book is we believe if you buy interest-only securities, which are just cash flow stripped off the bonds, these are, they could be 2-3 year interest-only securities. But when you get these extensions of the underlying loans, all of a sudden these IO strips, these cash flows that are just stripped off the CMBS bonds, they become 3-4 year bonds. So for us, it's kind of a unique way to play the distress in CRE and CMBS, where we're betting on losses on the most levered pieces of the CMBS because there's no other way to deal with this 1.4 trillion coming without the regional banks, without the CMBS market. Yeah, I mean, even the insurance companies who are a major lender to our market, usually on higher quality assets, even they're pulling back. And, everyone's trying to protect their own job. Everyone's trying to, save face. No one wants to do anything risky right now in CRE. So it's, origination volumes will be down across the board. And that's naturally going to lead to higher delinquencies, but in my opinion, even more extensions.
I'm going to assume that the moment you start seeing things really show signs of stress, you're going to tell everybody on Twitter to short the shit out of somebody. No, but both the but actually, I'm actually kind of where I'm going with this is, I'm always big on sort of these delayed spillover effects, right? So there's the argument that credit leads equities, right? So if there's going to be real stress that impacts stocks, you should see it first in presumably some of the positions that you're shorting really working in a suddenly much bigger way. From experience, Dan, are there how long is the typical lead time that commercial real estate, CMBS would, when their stress would start to matter for equity public market investors?
That's a tough question to answer, and then that's only because it depends on what sector is going to be stressing the system. And as we talked about, office is the biggest problem in our market, and office is the longest duration asset in our market. And that's just meaning that the leases are longer term versus the shortest duration asset in our market would be hotels, right? Because theoretically your lease could be one day, whereas office space you got 5, 7, 10-year leases or even longer in some places. So given that, and given the slow nature moving of the market, the lead time, it's going to be a while. I mean, whether that's a year, it's difficult to say. It's also difficult to say when the worries around office really started. I mean, I was jumping up and down a couple of years ago when we were launching Popo, saying, my biggest issue is finding longs to put against the shorts because I think office is going to be a complete disaster. Now today we've had major repricings in some of these sectors. Some of them aren't fully repriced to where we think they'll go, but I just, the focus on office that it really started, I would say, towards the beginning of this year, was surprising to me that it took people this long to really start freaking out. I mean, the data, if you just look at occupancy data in a lot of these cities, like Castle Tracks or whoever you want to use, we've really plateaued. The new normal in New York City is probably going to be 50 something odd occupancy. I mean, maybe it gets to 60, maybe. You've got Austin around 60 or so. Maybe that's just seems like where it's plateaued, and that's our new normal. And it's to put a number on the lag time. It's difficult, but I think we're now starting to get everybody, even the CRE owners and sponsors, on the same page where, okay, we have a problem and we need to deal with it. I mean, you heard RXR come out and say last month, they were going to probably give the keys back on some small portion of their portfolio, and they're very large office owners. When you start seeing that, and you start seeing the Brookfields of the world give the keys back, or say they may give the keys back on certain assets, that the institutional players, the large, smart money, that's going to start to trickle down to kind of the mid-level players. You have to remember that, this has really only been an institution. The CRE market's only been an institutional market for maybe 25, 30 years. Before that, it was very segmented in smaller players. There is still plenty of smaller players out there. And I think that, some of them I'm sure will do just fine, but I think you're going to start to see some bodies floating to the surface over the next 12 months where people got over levered, or people didn't get, buy their interest rate caps or whatever it is, or they just got stuck in, a bad office property that's never coming back. This is going to be, I don't know if equities just seem to be shrugging it off. I mean, obviously the S&P is doing just great today and has had a great start to the year, but commercial real estate is such a large part of GDP, and we can't have a wounded commercial real estate market and just ignore it, broadly speaking, from a macro perspective.
Are you seeing a lot of new entrants or competitors in the hedge fund space that, kind of thinking along the same lines as you? They see an opportunity and just these kind of traders are getting involved, or is it still pretty niche in terms of how many are actively starting and engaging?
Yeah, what we're seeing in our market is, your traditional CMBS and structured product hedge funds that play in these derivatives that want, to express bearish positions. It's a small market, but what happens is when there's this massive wave of distress that's either coming or just starting, we're getting a significant amount of incoming from very, very large hedge funds. And I know their question before we hop on a Zoom or on a call is how do I short office? How do I do this in CMBX? And my answer is, depending on who it is, or how big this person is you got to be careful, because you are at right now you may be too big for the market, or it may not be worth your time. And we're talking about 10, 15, 20, $30 billion hedge funds who, whether they make their money on the equity side of the business or the macro side of the business, they're looking at CMBX saying, okay, well, maybe these equities have repriced, but why is CMBX only down 20, 25%? That thing should go to zero. And that's the other side of the coin too. These CMBX instruments are there's one every year. It comes out every January. Right now, our most recent is CMBX 16. So it was all loans. It came out in January of 2023. So it was all loans done in 2022. And in these different instruments, because we keep talking about the sectors and how there's winners and losers, you have plenty of properties that, NOI is up dramatically, and maybe the valuation of the property is higher. So it's definitely not like shorting ABX in 2008, where you didn't have to worry about covering because it's just going to go to zero. It's a nuanced trade, and I think it's a trade that's done right, could produce some impressive returns, but it's not a market for very, very large players. It's difficult. We just don't have the open interest anymore. The most public short battle, whatever, in our market was the regional mall trade in CMBX 6. Now, the one thing, the largest player in that market, it's, publicly, he's been talking about it since COVID or a little before COVID, was a Carl Icahn. And, the difference there was you had very large money managers on the other side of that trade, and you had open interest over 10 billion in the credit part of CMBX 6. Well, today, if you look at the credit part of our markets, nobody wants to take the other side of an office short. So you're talking about, you went from being able to short billions of CMBX 6 and express bearish views on malls to being able to short hundreds of millions of more recent vintage CMBX. So that was a long-winded answer to your question, that there is a significant amount of interest to come in to short CMBX. But I think what people are finding is it's not as easy as it sounds.
That's a good place to wrap this Twitter space up. Dan, aside from Twitter, where else can people find some of your thoughts and work?
Just Twitter, really. I try to keep up with Twitter. I get pulled in many different directions, but I'm most active on Twitter.
All right. Thank everybody for joining. Appreciate your time here.